Welcome to The Explainer. Today, we're unpacking an absolutely massive paradox happening right now in the Australian real estate market. On the surface, the rental market is breaking records. Property managers are pushing asking prices to the absolute limit, and desperate tenants are competing fiercely just for a dwindling supply of available homes. But underneath all that surface noise, property investors across the nation are quietly bleeding cash faster than ever before. We are heading straight into what's been called the 2026 holding cost crisis, and it's catching thousands of investors completely off guard.
Okay, let's dive into this because we really need to contrast what you're hearing in the mainstream media against the reality of what's actually happening behind closed doors. The mainstream headlines focus almost entirely on booming rents. They paint this picture of the landlord illusion, the idea that if you own property right now, you're sitting on a gold mine, effortlessly collecting massive weekly checks that make your portfolio totally self-sustaining. But today, we're going to look past that media spin and expose the reality of debt. We'll be calculating the brutal math of what it actually costs to hold an Australian investment property today. Understanding this trap is the only way to save a portfolio from forced liquidation over the next couple of years.
Let's start with the stat that's driving that landlord illusion. Across our capital cities, national weekly rents have jumped by an average of 5.9% over the last year alone. For anyone holding property, seeing that number go up feels incredibly validating, right? The rental demand is intense, the competition is extreme, and on paper, an almost 6% jump in gross revenue looks like a massive win for your bottom line. But revenue is only half the story. Now here's the brutal counter-statistic that completely shatters that illusion. While your rents might be up 5.9%, your borrowing costs have absolutely skyrocketed. Thanks to the Reserve Bank of Australia locking the cash rate at a very restrictive 4.35%, the average variable interest rate for a new property investor in Australia is now sitting at a staggering 6.4%. That single number changes literally everything about how a property performs. So what does this all mean? Well, the crucial point is understanding what happens when those two numbers collide. When your mortgage interest rate scales significantly higher than your gross rental yield, you enter what we call the negative cash flow drain. Your property instantly shifts from being an income-producing asset to a massive liability. The gap between what you earn in rent and what you owe the bank each month becomes a vortex, just actively pulling money out of your pocket.
Section 1. Anatomy of a shortfall. Let's break down the real math here.
Take a look at this incredibly realistic case study. Let's say you purchase a standard, established property in a major capital city for $850,000. The market is hot, so you secure a strong weekly rent of $650. That sounds awesome, right? But run the math, and your gross rental yield on this asset sits at just 3.9%. Now, compare that to your debt. If you hold a standard 80% loan on this property at today's rates, your annual interest repayments alone will exceed $43,500. That 3.9% yield is completely eclipsed by the massive interest bill, and we haven't even touched on the running costs yet.
To get the true picture, you have to subtract the operational costs from your rental income. We're talking about property management fees, local council rates, skyrocketing insurance policies, and the totally unavoidable costs of general maintenance. These are the hidden holding expenses that never make the front page news. Once you subtract these from your already stretched rental income, the math gets frankly terrifying.
Here's the brutal punchline. After the rent comes in and the interest and hidden holding expenses go out, the owner of that $850,000 property is left facing a net annual shortfall of over $15,000 every single year. Your investment property isn't paying you. You are paying heavily just for the privilege of keeping its doors open. To put that into perspective, let's translate that annual number into daily reality. A $15,000 shortfall means you must personally inject $1,250 of your own post-tax salary into that single asset every single month just to keep it afloat. Think about the personal pain point here. Taking over $1,200 out of your family budget every month is stressful enough on one property. But if you multiply this shortfall across a portfolio of 3 or 4 properties, no way. This holding cost crisis turns into an absolute wealth killer. It's a completely unsustainable drain on your personal cash flow.
Section 2. The broken property playbook.
Now, you might be wondering, hasn't this always been the Australian way? Buy property, rely on negative gearing, take a loss, and let the market do the heavy lifting? Historically, yeah, investors willingly accepted these negative cash flow scenarios. Why? Because they relied on massive, predictable capital gains to bail them out. They took the monthly loss, knowing the property value would skyrocket over a decade. But that old strategy, that capital gains safety net, has completely broken down under the weight of the RBA's higher for longer interest rate reality. The macroeconomic environment has fundamentally shifted. And don't just take my word for it, look at what the major data houses are saying. Institutional heavyweights like CBA and NAB are actively warning of major price corrections across our largest property markets. Capital growth is dramatically slowing down, and in major hubs like Sydney and Melbourne, it's actively reversing into negative growth. So, going back to our math, you're paying over $1,000 out of pocket every single month to hold an asset that the major banks are explicitly forecasting will lose value. That is a recipe for financial disaster.
Which brings us to Section 3, Elite Survival Strategies.
And this brilliantly illustrates why the old way of lazy, set-and-forget property investing is over. But hey, it's not all doom and gloom if you know how to adapt. How do elite, mathematically disciplined investors survive this severe cash flow squeeze without destroying their long-term wealth? Well, they follow a highly structured three-step framework. First, they automate their data. Second, they ruthlessly optimize their debt. And third, they target high-performing regional markets. Let's break down exactly how you can apply each of these to your own strategy right now.
Step 1 is taking absolute control of your numbers. You've got to transition away from manual tracking and implement automated expense auditing utilities. Elite investors use structured data frameworks that instantly parse line items from their bank statements to isolate hidden recurring leaks. By ruthlessly auditing every dollar spent on strata levies, property managers, and compliance fees, you can often optimize your net yield by up to 0.5%. In a high-interest environment, squeezing out every fraction of a percent in efficiency is absolutely crucial. Step 2 is ruthless debt optimization. You literally cannot afford a lazy mortgage in 2026. You need to sit down with a specialized mortgage broker and aggressively review your current financing structures. The goal here is to negotiate with your lender to ensure your variable rate is accurately priced against the absolute lowest tier available in the market today. Plus, if your cash flow is severely constrained right now, it is entirely strategic to consider pivoting a portion of your portfolio to interest-only terms temporarily. Doing so can instantly lower your monthly outgoings and buy you the breathing room you need to survive the squeeze.
Step 3 is fundamentally shifting where you buy. If you're looking to acquire more assets, you must adjust your buying criteria away from low-yielding capital city apartments. The data clearly points toward high-performing regional hubs, and the golden metric to look for? A vacancy rate clamped tightly below 1%. You're looking for regional areas backed by diverse local employment and massive infrastructure projects, where tenant demand absolutely overwhelms supply.
The reason elite investors are flooding into these specific regional markets is simple. They offer yields that actually make mathematical sense. These high-yield locations deliver positive cash flow right out of the box. This completely eliminates the need for those painful monthly salary injections. The property sustains itself, pays its own debt, and shields your personal income from the holding cost crisis.
I want to leave you with this defining thought that perfectly summarizes the current landscape. The era of lazy property investing in Australia is officially dead, and only the mathematically disciplined will survive. This is the brutal new reality of the Australian real estate cycle. Hope is not a strategy. Capital gains are not guaranteed. The only thing you can control is the mathematical reality of your cash flow. If this explainer gave you the exact clarity and the data-driven frameworks you need to protect your portfolio, make sure you hit the like button. And more importantly, subscribe to RaaGaa Wealth and Invest. Our goal is to ensure you stay ahead of every breaking economic update and real estate shift so you are never caught off guard by the market. Finally, I want to hear directly from you. Let's do the math together. Drop a comment below and let me know. How much is your property costing you out of pocket every single month? Are you feeling the squeeze? And which of these elite survival strategies are you going to implement first? Let's analyze the numbers together. Thanks for joining me on this explainer, and I'll catch you in the next one.